Hello everyone, and welcome to Business Hub. Investments that you intend to retain for longer than 5 years are considered long-term. It's critical to choose an investment that has a probability of succeeding and will assist you in achieving your long-term goals. The long-term investments with the best risk/reward ratios are those. Among the most popular long-term investments include securities like stocks, mutual funds, bonds, and real estate. Stocks. Financial instruments called stocks represent a share of ownership in a publicly listed company. Owning stock gives various legal rights and benefits, such as the right to dividends, since shareholders have a direct proportionate claim on the company's income. They could also be given voting privileges in line with the company's corporate charter. When a company offers stock, it raises money to fund its activities. Shares of stock, a kind of asset that signifies ownership of a corporation, are the securities that you really hold. If you possess stock in a company, you are a part owner in it. When you purchase a stock, you are making an investment in the future prospects of the firm. By diversifying your investment portfolio with equities, you may be able to increase dividend payments and long-term profit possibilities. Companies that trade publicly issue stocks. This shows that these companies have the legal right to issue a certain number of stocks, which are then sold to the public as shares. A little portion of a corporation is essentially purchased each time you buy a share of that company. Investing in stocks may be profitable if you choose the right stocks and comprehend the fundamentals of the companies that support them. When buying stocks, the two main investment categories are growth stocks and value stocks. Growth stocks are shares of companies that have had a significant growth in their profitability. These stocks are often associated with new, rapidly expanding technical corporations. These stocks may be highly volatile, yet offer a high potential for price growth. Value stocks, on the other hand, are equities in companies whose shares are now selling for less than they are really worth. These stocks provide a great opportunity to buy reliable companies at a bargain and often generate significant dividends. It is critical to understand that a firm may issue many share classes. Common stocks, the most common kind of stock, do not provide any special rights or advantages. Instead, they just offer a proportional claim on the company's profits and dividends. On the other hand, preferred stocks are distinct classes of stock that provide the holder certain benefits, such as greater dividend payments and the ability to buy more shares of common stock at a discounted price. Mutual funds. Mutual funds are a kind of well-managed collective investment plan that invests in a wide variety of assets, such as stocks, bonds, and money market instruments. These investments provide a dynamic and interesting portfolio that is managed by an experienced financial professional. Investors are allowed to join and quit mutual funds whenever they want to change their portfolio due to the open-ended structure of the funds and the daily buy and sell activity. Investors may diversify their portfolios and reduce risk associated with owning a single kind of investment with the aid of mutual funds. A mutual fund allows investors to diversify their risk by buying a mix of equities and bonds. Since mutual funds are carefully managed and the fund manager will do the required research and choose the best investments, investors just need to be aware of the aims of the mutual fund. When compared to other assets, mutual funds provide a number of important advantages in terms of investment potential. Mutual funds have the advantage of allowing even novice investors to diversify their portfolios with a reasonable amount of capital. By carefully diversifying their assets, an investor may reduce the risk associated with any one stock, bond, or asset type. Mutual funds are the ideal way to begin investing since smaller investors don't have to stake a major portion of their portfolio on a single asset type. Mutual funds also have the capacity to provide reliable returns. Every investment has some risk, but skilled money managers may diversify that risk over a larger variety of assets, possibly reducing volatility and ensuring more steady returns. Mutual funds allow investors to access stocks and bonds without having to buy and sell individual shares. This is a far more cost-effective approach to making long-term investments. Another advantage of mutual funds is the wide range of opportunities they provide. Whether you want to invest for income, growth, or both, there is likely a mutual fund that may help you achieve your goals. One industry, such as energy, technology, or healthcare, is the focus of certain funds. You might also decide on a fund that makes investments in a larger range of sectors. A fantastic way to save money for retirement is via mutual funds. Some mutual funds may be offered via a 401(k) or other workplace retirement plan, allowing members to defer paying taxes on their holdings until they begin taking withdrawals. Investors may benefit from a money manager's expertise while saving for their retirement, since mutual funds are managed by experts. Using mutual funds may be quite advantageous for any investor. You may access a professionally managed portfolio and benefit from the added security that comes with diversification with the right fund. Because of this, mutual funds are a popular choice for both new and experienced investors wishing to manage their portfolios. Bonds. Businesses, governments, and other organizations issue bonds as debt securities. When you buy a bond, you are lending money to the issuer in exchange for interest payments. Bonds are often seen as safe investments that might provide steady returns over time. Actual estate. Real estate is a kind of asset that includes tangible assets like land, structures, and resources. It covers the purchase, sale, and development of real estate. Real estate deals may include any kind of property, including residential, commercial, industrial, agricultural, and natural resources like oil, gas, and minerals. Investments in real estate require a substantial initial investment and are cash flow intensive. Additionally, they are unstable because of the possibility of significant price volatility as a result of market changes. Therefore, prudence must be used while making real estate investments. Understanding the risks and potential rewards of real estate investments is essential before making any financial commitments. Real estate investors often profit from two sources: capital growth and cash flow from rental income. When the value of real estate increases over time, whether as a consequence of macroeconomic factors like population growth and rising wages or the local economy overall, this is referred to as capital appreciation. Cash flow is produced when a property is leased to a tenant. Investors may also profit by redesigning and reselling properties, making upgrades to entice higher-paying tenants, and other value-add strategies. Real estate investment strategies may be passive or aggressive. One popular way to invest in passive real estate is via the purchase of existing properties through a real estate investment trust, REIT. Buying real estate, constructing or remodeling buildings, or creating value via development or renovation are all examples of active real estate investments. It is important to remember that real estate investing is not a set-it-and-forget-it kind of investment. A landlord is required to keep an eye on potential tenant evictions, ongoing maintenance costs, unoccupied properties, and changing market conditions. Therefore, active real estate investors need to keep their homes in good condition. Real estate investments may also provide tax benefits. Depending on the kind of investment, investors may be able to write off depreciation, mortgage interest, capital expenses, and losses on the sale of the property. Clearly, there are risks associated with investing in real estate, so it's critical to thoroughly consider an investor's goals, risk tolerance, and current financial situation. Before making an investment, it is essential to consult with a financial advisor for advice on the best strategies to guarantee a successful real estate investment. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel for future updates. Thanks for watching.